Welcome to Cryptonomics. Today we will discuss upcoming earnings of Oracle, Adobe, and Costco, economic data the market is anxiously waiting for, summary of crypto, the way stocks are looking today in the markets, an overview of the return of our stock portfolio. Let's get started. Alright, so for the week of December 11th, there are a few companies that we're paying attention to. First, on Monday, the 11th, Oracle is delivering their earnings after the market closes. This could be an indicator for other companies in a similar industry. Next one that we're excited for is on Wednesday, which is Adobe. Adobe has seen a tremendous rise, especially with their use of AI technology in their service offering, plus their acquisition of Figma. Though the Figma acquisition is currently being held up by the UK courts due to antitrust issues and regulations, we believe that will go through like most other mergers and acquisitions have, especially because the two operate in kind of two different segments or sectors of the graphic industry. And then Thursday, we have Costco reporting earnings after the market closes. Let's briefly take a look at what's happening in the market today. It looks like it's mostly green, but all the big names in tech seem to be red. Now, these are the Magnificent Seven that have been responsible for a large portion of the S&P 500 growth, and I believe S&P 500 is up 20% for the year, but these collective large cap tech stocks are up about 70%. If I look at this, what this tells me is the market is taking some profit from the big names that have gained a lot this year, and they are reallocating to smaller caps that have not seen as much of a bump this year. We'll see how the market closes by the end of the week, but this could be a shift from large caps to small caps. Lastly, there are two major macro events for 2023 that will greet investors this week. On Tuesday, November's Consumer Price Index numbers will come out, which will be the last piece needed to complete the inflation puzzle for the year. And the Federal Reserve's final policy announcement for the year is due Wednesday afternoon. So if inflation is looking contained, then there is no need to keep raising interest rates. The jobs numbers that came out last week are looking good, and the Federal Reserve has a dual mandate to keep inflation at 2% and unemployment low, stable. So they're still tackling the inflation. Unemployment is looking good, which means they have some wiggle room if inflation is still high to raise interest rates and lose a few bips from the employment numbers. If inflation is contained or low, that means that the hawkish Fed policy of raising interest rates or keeping them this high might finally come to an end. This will be a very positive impact on the tech stocks. If inflation, however, is looking higher than expected, that means that interest rates will remain higher for longer or perhaps even go up, which will be probably negative for tech stocks and maybe the entire market. So let's keep an eye on these two key metrics that are coming out this week and see how Fed moves the markets. Along with their final policy decision for the year, Fed will also release the updated summary of economic projection, which includes a dot plot map of the policymakers' expectations where interest rates could be headed to in the future. Forecasts on inflation, GDP growth, and unemployment will also be released. Now, a dot plot is an interesting little chart. 4 times a year, March, June, September, and December, policy setting Federal Open Market Committee, also known as FOMC, sends a summary of economic projections. This includes a forecast where key economic indicators will be. The release also includes a dot plot, which maps out each member's projections for the interest rates in the coming years over the long run. The dot is not labeled, and each person who submits their forecast is leaving it to the Fed watchers to speculate who made the projection. And this is what it kind of looks like. The members don't coordinate, they submit their projections independently, and this is what it looks like. This is in 2021, 22, 23, and long run expectations. Okay, so this is their projections. This is what the market would be looking out for to see the distribution and see if there's agreement with the FOMC or what's happening next. Just moving out here, so this is what you couldn't see. All right. Next, let's take a look at cryptocurrencies. Bitcoin and Ethereum are both down about 5% in the last 24 hours, along with many other cryptos that are down about 5%. This is a common pullback. Things don't just go straight up. Market cap is sitting about 1.56. This is giving back, I think, 100 billion from a few days ago. Now, a good thing to take a look at is what is happening overall. Is the entire market crashing, or is just selective few? And it looks like there's still plenty of double-digit gainers amongst the mostly down 5% pullback in the rest of the market. So this is a healthy pullback. And if we look at the fear and greed index, it is still in the extreme greed. So market might pull back a little more because it has seen a exponential growth in the last few weeks. As we can see here, the fear and greed index is in extreme greed, which signals that there might be another potential pullback, perhaps more severe, more volatile. It is not uncommon in crypto for investors, especially traders, to leverage themselves up to the tits and get themselves in trouble. If there's any volatility that works against them, causes a cascade domino-like of liquidations, causing a much more volatile reaction in the market than a couple of percentage points. So 5%, that is middle ground, okay, pullback. If it is double digits, it's probably due to cascade of liquidations because, again, investors and traders leverage themselves up to the tits and were liquidated. As you can see here, just in the last 45 minutes, there was $150 million that were liquidated from crypto markets. Since the market is down, that means these liquidations were on the upside. The investors were betting that prices were going to go up. They leverage themselves up to gain extra from the upward movement. If the movement goes against them, it causes automatic liquidations to close their positions, giving the gains to those betting against the market. Lastly, let's take a look at our portfolio performance for the year. The year is not over yet. Of course, things can change, but our current performance is looking stellar. Year to date, we have 3 portfolios, and they are totaling 142.43% return. Compare that to the S&P 500 index.
Novak, congratulations. Okay, 7 Australian Opens, 15 slams.
Not too bad.
Not too bad.
S&P 500 index that has a 20.8% return, or the Dow Jones that has 19.6%. We are blowing the benchmark out of the water. Now, this is not always the case. We don't always do better than the index. Some years we are down relative to the index because our portfolio allocation is much more aggressive than your standard 500 biggest companies in the market. Our portfolio is geared towards high growth tech stocks, and how we choose these is what this channel is about. So if you want to learn how to allocate your stocks more aggressively and follow along with our portfolio, don't forget to subscribe, follow, and share. Thanks for watching.
Slams,
Not too bad.
Not too bad.